Welcome to the 9th Annual HHF Investors Forum. To those of you who are just joining us, we want to thank our sponsor of this private equity and private credit panel, Barnes & Thornburg, LLC. Joining the panel, we have private market investors that will discuss the investing landscape to allocate more assets to the private equity and credit markets. They will also discuss more about microcycles, deal flow in tech, and how COVID has impacted this market. Moderating the panel, we have Vazquez, partner and venture capital at Sway Ventures. Please take it away, Albert.
Thank you very much, Claudia. Hi, everyone. I'm delighted to host a fantastic group of 5 capital experts to talk in the next hour about private equity and private credit. Moderator Vazquez, partner at Sway Ventures, $500 million AUM venture capital firm that invests in the sustainable transformation of foundational industries. Happen to be a former PE operator with the Kala Group, and I get my feet wet in the PE world for my personal entity, B612. The speakers of today are accomplished professionals with diverse backgrounds in the ecosystem of private markets. So let me introduce them. Rodney June is the CIO of the Los Angeles City Employees Retirement System. He will provide the view of a multi-billion pension fund, highly committed to diverse and emerging managers in a variety of asset classes. Welcome, Rod. Sheryl Mejia at the Steward Asset Management is an anchor investor to private equity teams approaching their first institutional launch. The firm focuses on healthcare, consumer, industrial, and technology sectors in the US middle market. Hi, Sheryl. Gerson Guzman at Ceiba Capital Partners will provide us the perspective of an emerging buyout firm specialized in the lower middle market. Gerson, hello. Bhairvee Shavdia of HCAP Partners is a provider of private debt and growth capital to lower middle market companies throughout California and Western United States. Glad to have you, Bhairvee. Last but not least, Anthony Arnold leads M&A practice, private equity, and venture capital at Barnes & Thornburg. He's a trusted advisor, instrumental in analyzing all sides of key legal and business issues at various investment funds at their portfolio companies. Anthony, great to see you again. Thank you to our speakers to join us. Please turn your cameras and macros so you will, if you have not already done that. And it's going to be an accessible conversation. And I look forward to learning more about you and the perspective you bring to the topic of private equity and private credit. Thank you to the audience for joining us today. We have a channel of questions below. We have a dynamic conversation with our panelists. I prepared some starter questions for every speaker. And from there, the other panelists will have the opportunity to jump in and add their thoughts or make questions to the other panelists. So we want to do that as dynamic as possible. So let's start first with Sheryl from a Steward Asset Manager. Because as an anchor to buyout funds, you write the first check to a fund that will operate around 10 years, and you validate the strategies that appear to be more aligned with the incoming economic cycle. Mm-hmm. And capital market activity across asset classes surged in 2021, propelled by broad market optimism and a favorable issuance environment. However, in certain asset classes and geographies, momentum has slowed since the start of 22 due to a variety of headwinds. I want to get your thoughts on where you think we are for private equity and the private credit cycle.
Thank you, Albert. Great to join you today. 2021 certainly underlined the value of private equity to investors' portfolios in terms of strong returns, certainly above trend. 2022 turned a definite chapter where the IPO issuance stalled, really on the back of some disappointing new issues and some concerns within the SPAC construct as well. But truly, the private equity and private credit markets, I think that our eyes really have to focus on 2 things as we sort of assess this slowdown in terms of the number of exit opportunities for large buyout and for large VC. I tend to focus on the middle size and lower, so we're not as affected by the IPO issuance. Although there is a chain of purchases and combinations, which I'm sure Anthony and some of the other team members panel members can talk to. The interesting thing, though, as you really think about valuations in this market, I think our eyes are on two things, and one is the consumer. We're really in this very attractive period for consumers and jobs, and we see this engine of growth, of the strength there. And the interesting component of the consumer is that there's a lot of changing tastes, which really lend to smaller, more innovative players. And so some of the organic growth that come there. The second thing is, I think the most important thing for beneficiaries and fiduciaries who manage plans is the combination of growth plus inflation, because inflation isn't as scary if you have growth. And so really with that eye on growth as well as the consumer and the capital available, and the importance of the conversation today of that capital availability in the growth, in early growth opportunities. And it covers, I don't focus on venture, but hats off to our venture incumbents who have really attracted so much capital. The middle market growth equity story is a growing component of portfolios that we tend to watch very, very closely. And we see a lot of innovation coming up there, but we also see companies with incredible working capital needs right now. So the inflation is really impacting wage and shipping and inventories and raw material costs. And so our capital is more and more valuable, and really getting down to a granular level as we think about many of the different themes we love to see, which is diversity, inclusion, and ESG, some of the things talked about earlier. When you think about financing a new small buyout or giving capital to a new growth equity diverse manager that's in Fund 1, it's really, capital is so important, not just at that level of the diversity, but the next level down to make sure, those teams tend to have a great lens on inclusive themes and growth themes, and the things we see in our portfolio, and we certainly have a lens on diversity naturally, because there's a lot of capital support in the ecosystem for new diverse teams in growth equity and small buyout. But the key there is that they definitely tend to be the engine for some of the larger appetites in the inclusive and diverse ESG opportunities, such as component parts for electric vehicles, or AI for inclusive healthcare themes. You're seeing a lot of technology, healthcare, and industrial innovation coming out through the middle market right now. So I'll stop there. There's been a lot of microcycles. I'm sure others can contribute to what they're seeing in the cycle. I didn't touch on private credit, but I'm quite productive on private credit because of because the inflation is usually very productive for it as well. So I'll pass it off to the next back to you, Albert, to direct us.
Sheryl, I was curious because when we talk about the dry powder of the private equity industry, the numbers, you're staggering still. But if you do the segmentation between what's dedicated for really large market, middle market, lower market, can you comment? Because we tend to just fix on the big number, but then understanding the different strategies in the private equity. Could you comment on that?
Albert, the fundraising and the dry powder in the middle market and the strategies with funds sizes under $1 billion has not recovered for a number of years. And it has been in a slump since the downturn. And I think that's actually more of a factor for smaller managers having fewer LP relationships and not being able to build as many new ones. And there's been a lot of family offices somewhat taking advantage of that because they'll do more direct deals. And so the deal flow has stayed somewhat steady, but the capital coming into dedicated funds for emerging diverse managers, we see it. We've seen over 200 managers in the last year and a half that are trying to launch their first fund of growth equity and buyout, and very few have made it through yet to the capital because of the relationship building. The dry powder is definitely in the large size. And I'll just give you a couple of numbers to contrast the deal flow. When you're thinking about companies that are in the large buyout versus the middle market, The large buyout has about just between 1,000 and 2,000 companies they can look at in the United States. And in the middle market, there are 200,000 companies. So it's largely underfunded, and we still see a lot of single bid transactions, transactions occurring at 5 and 6 times EBITDA, which speaks to an underfunded market.
That's right.
Market, yeah.
Perfect. So that gives me a great segue, maybe to transition to Rod. Lasers is the retirement trust for the civilian employees of the city of Los Angeles. You're in a unique position as an LP. And in one of the previous panels today, you already shared your specificities on balancing long-term horizon with opportunistic short-term opportunities. Any thoughts related to sector or investment strategy, knowing that this is about buyout and credit, and you have this overall visibility about the different dynamics between middle market, large caps, regions, sectors. What can you share?
Yeah, well, thank you. I think what might be helpful, since I think I'm the only public pension plan represented on this panel, is to provide some context about who we are. And I think that will help the listeners better understand our approach to the private markets. So we're about $22 billion public pension plan. And as Albert said, we serve the civilian employees of the city of Los Angeles. As I said earlier on a panel today, that we are very long-term investors. And so therefore, we're not trying to shoot from the hip and spring from the chandeliers per se. We do work within a construct of a strategy, a very long-term strategy. And we invest not necessarily to recognize the ups and downs, meaning that we're not tactical, but we tend to invest very long-term oriented, and then we stick with that plan. So let me move to, of our $22 billion, we have a 16% policy target to private equity. And when I speak of private equity, that also includes venture capital. And venture capital constitutes about 20% of that 16% target. And by the way, because of the denominator effect and the value of the fund having dropped, we're about 17.5% actual weighting versus our target, so we are over. And then in terms of private credit, we have a 5.7% target there. It's a relatively new sleeve for us. It actually belongs within what we call credit opportunities, the asset class there. So anyway, that kind of gives you some structural context about our program. So when we invest, we do talk a lot about sectors and specific strategies, but what we're really trying to do is build a diversified private equity and private credit portfolio. And I'm really going to focus my comments more on private equity because we've been in that asset class area for over 25 years. Private credit is very relatively new for us. Despite market cycle changes, and I've lived through a number of them, from the tech bubble to the great financial crisis, a lot of volatility around 2010, and then we went into the COVID. We still try to build portfolios, not necessarily based on sectors, but to be fully diversified, recognizing that we're in this asset class for the long term. And many of the funds that we go into have 10, 15-year lifespans. So we feel that just allocating somewhat evenly and balanced across different sectors is more the appropriate thing to do. That's not to say that when we have a discussion with our consultant, that they and my own staff and I don't recognize what part of the market cycle we're in. For example, now healthcare has taken a lot of importance because of COVID. Technology, there are some good funds. There are some that aren't doing so well. Energy, alternative forms of energy because of ESG. We do recognize that there are pockets of opportunity, but overall, we do try to allocate to create a very diversified sort of across vintage year. In terms of sectors, we're really invested in just about everything you can think of. We're allocating a little over $1 billion in commitments each year. So that gives us, I think, that opportunity and some benefit of really not having to pick and choose so carefully, but to, again, keeping that diversified theme in place. I think overall, we've been in this asset class for a long time, so our portfolio is very deeply entrenched across a lot of vintage years, across a lot of sectors. So we're just going to continue sort of taking that long-term strategic approach. I would say that one of the more important things is not necessarily choosing sectors per se, but we are very focused on choosing the right general partner to invest with and really building on that relationship with the best general partners. We get a number of new managers that come across our desk, especially since we have a priority towards emerging managers, and we do have a goal of allocating no less than 10% of our capital across all asset classes to emerging. But by and large, what we try to do is build relationships with the best GPs out there and do follow-on funds. We are open to doing business with new GPs, but sometimes I think in this market cycle that we're in, we prefer to stick with the general partners who we've had long-term relationships with. So I'm going to pause there, and Albert, I'm going to turn it back over to you.
Thank you very much, Rod. I think that we're going to be bringing back the topic about capital allocation, mid-market versus larger tickets and larger funds, because I think that this is going to be an interesting conversation. So I'm going to be putting that in the parking lot, and we will come back to that later. Meanwhile, I would like maybe to get the perspective of two fund managers that we have on the panel and the amazing legal advisor in such private market ecosystem. So let's start with Bhairvee from HCAP Partners. And I'm curious to learn how private credit integrates ESG into its various strategies. Because, I mean, while credit managers are typically not involved in the direct management of businesses, how do you make impact investing work?
Yeah.
Feel free to introduce the company in more detail.
Yeah, no, thanks, Albert, and appreciate the invitation to join. So I think I'll start by just setting a little bit of context around HCAP, which will help inform a bit of the conversation around private credit and ESG. So HCAP, we're an SBIC fund based in San Diego, and we provide both mezzanine financing and growth equity to companies in the lower middle market. So typically companies that have 1 to 5 million of EBITDA. We're usually the first institutional capital into our founder or owner-led businesses. Sectors that we focus on are healthcare, software, and business services. And, specific to this conversation, we're also an impact investing fund, and we have an impact thesis around quality jobs. We believe that investment in human capital is critical for business success, and we work with our portfolio companies to improve job quality standards over the life of our investment. As we think about, again, ESG and private credit, I would say that, we have seen a much more receptivity around ESG lately from the private credit sector. It's a topic that we consistently see come up at industry events. If we're kind of thinking through different ways that private credit funds are integrating ESG into their strategy, I kind of boil it down into three main ways. The first is screening. So this is basically applying filters, often as a first pass, to screen out opportunities based on preferences around industry or alignment with investment mandates. And this is really the main approach that we're seeing for most private credit funds in the market. So sort of this, first pass ESG approach. I would say kind of moving from there, the second strategy that we've seen is one around integration. So that really means, including ESG issues during the diligence process and making ESG a factor of underwriting. We're starting to see more funds incorporate integration into their underwriting and have sort of ESG or impact diligence pre-investment. And then the third approach is really thematic, and it's a strategy around intentional engagement with portfolio companies post-close. And this is really kind of to create change and where we see the impact investing funds playing. Again, for private credit funds, this engagement is nuanced, just by the fact that we're providing debt instruments and we're not able to sort of mandate impact at a portfolio company, from a majority equity stake. And so there really needs to be buy-in from management teams around impact, pre-close, and strong vetting around sort of alignment with impact frameworks, with, potential investments. I think, we've seen funds do one or a combination of all of these. And then, the other thing is that funds are starting to take a much more data-driven approach around identifying change and putting in KPIs, both at a company-specific and a portfolio-wide level around ESG. I mean, there's a growing field of impact monitoring and measurement firms that have really been created over the last 5 to 7 years, right, to service these smaller funds that are incorporating ESG. Many small funds don't have the bandwidth in-house to do this type of work, and now you're starting to see these essentially, very powerful off-the-shelf solutions around data collection, monitoring, and reporting. For a lot of the larger funds in the market, which traditionally focused on buyouts, but now, have private credit funds as part of their strategy as it becomes an increasingly attractive asset class, right? We're seeing this work still being done in-house by firm-wide teams. So sort of taking, right, that flagship fund strategy around ESG or impact and seeing how it can be brought into different funds. And, I would say that looking forward, right, for the next evolution of ESG, it's really being able to show from a metrics standpoint, right, how the incorporation of ESG is resulting in enhanced returns, and that's an area where I see a lot of funds, both on the buyout side and the credit side, really kind of focusing their time on right now.
Awesome. So I'm very intrigued about the KPIs that you are tracking on non-financial and as well financial. So I would like to understand what are the things going on at your Porcos that maybe are concerning to you right now, and of course that they would be non-financial metrics related to ESG, but as well more financials according to the current cycle with inflation, labor, inventory disruptions. What are the risks you foresee, and what are the things that your portfolio companies are doing to protect them?
Yeah, absolutely. So, I think two of the key things that we've really focused on from a portfolio-wide level have been supply chain issues and labor, right? And both of these challenges have, just been compounded by inflationary factors, really at the lower end of the middle market, even pre-pandemic, right? It was a challenge to, attract and retain talent, especially, since that's such a critical component in realizing investment thesis for growth. I think what, the pandemic and then last year, right, has shown us is that, again, labor is such a critical component of our portfolio companies. And what we've seen is a lot of our management teams really focus in and hone in on employees, especially frontline employees, to make sure, that they don't have disruptions to their businesses. For example, if we've got a healthcare services firm and, a lot of the caregiving staff is not able to show up, right, we've got a serious business issue there. And so, how we track that is through approach that we call sort of the gainful jobs approach. And we've developed this to really figure out what are key, benefits and policies we should be putting in place at our portfolio companies to be able to, retain the talent that we have and recruit talent. And so, when we're thinking about KPIs, ultimately, what we're looking at is, when we're rolling it up, what are turnover rates, right, within each of our portfolio companies, and also what is employee satisfaction and employee engagement. We actually survey, each one of the employees at our portfolio companies because that's a very powerful tool, just to understand sort of satisfaction with the current, portfolio company. And we're able to take a lot of that to then create, tools or create policies, put in place benefits, create employee engagement committees, and we did an analysis of sort of, what is our turnover rate within our portfolio last year relative to, nationwide averages that are also sector specific. We're able to see, right, we came out, considerably better, right, just given all the emphasis that we've been putting in on focusing on job quality.
That's awesome. That's awesome. I think that this topic about labor, how to retain labor, how to augment labor, maybe can it be as well a great segue to bring Gerson in the conversation? Because when we had our call to prepare this panel, me as a tech venture capitalist, I was delighted to learn that Ceiba Capital Partners as a buyout firm creates value through tech enablement and digital adaptation, in addition to established private equity value creation methodologies. And as a former private equity operator, I realized the risk of obsolescence for the traditional playbooks used to improve EBITDA and expand multiples. So Gerson, can you share more about what you do, how you do it, and how you identify and implement technology and digital solutions to accelerate a company's growth and scale?
Yes, thank you, Albert, and thank you to the Hispanic Heritage for having us here today, and to my fellow panelists for allowing me to share the stage. I'll give a little bit of background. I came of age during the dot-com boom, right? And technology was all about innovation and dynamic new business models. But in many ways, technology has matured. Yes, there's constant innovation, and I'm not here to talk about blockchain and crypto today, but there are so many tools available to companies to really address a lot of the challenges that even Bhairvee touched on. So at Ceiba, our focus is a deliberate buy and build approach. So we're looking for opportunities upfront where we can consolidate a fragmented market. Many times we're building the platform as opposed to just buying an initial platform. And we do this within a set of defined sectors. So business services and healthcare services. And then we also have two themes around enthusiast end markets and light manufacturing. These are themes that lend themselves to our value creation focus through technology. And at the end of the day, much like any private equity firm, we are focused on improving the earnings of a business, scaling the business, creating a sustainable business model, and ultimately improving free cash flow conversion. So if you just take those elements straight out of the financial statements, you're looking for technology and tools that allow you to grow sales. And that's either through innovation, new product development, or implementing, and again, focused on the lower middle market, tools off the shelf like a CRM or databases that allow you to more effectively target clients and convert those clients. On the cost side, addressing efficiencies through the same implementation of technology. So when I started in this industry 2 decades ago, the big technology implementation was an ERP or a financial accounting package. Those to us are table stakes. If they're not already there, we've got to have a plan even before we close how we're going to do that. But back to the topics on supply chain and labor, right? How are you recruiting? How are you training? How are you retaining that workforce? And are you simply managing a simple shipment relationship, or do you have 3PL software that allows you to identify lower cost solutions or improved solutions for LTL or FTL delivery for your products and services? And then ultimately for us, it comes down to that multiple accretion play. How do you improve the multiple? Well, if we've scaled the business and we've improved its free cash flow conversion, then naturally we're going to be able to generate a result where we're going to be able to sell a better business with higher earnings at an improved multiple. So I think a lot of the topics that HCAP works with their partners, their equity partners, is where we're focused on as well, except we're taking this value creation lens where we try to work with management where we say, okay, if you have an issue, if you have an opportunity, don't just look at throwing another body at it. What are the tools that are available that we can use to build a better business?
Okay, so I understand that as well, part of your due diligence is really getting the buy-in from the management to really adopt those value-add strategies. So how do you source your deals? What are the secret sauce so that you can get to the right firm to apply your strategies?
Yeah, great question. We like to practice what we preach. So before my partner and I even launched the firm, the first thing we did was look at our own technology stack. So we got a CRM implemented before we hung out the shingle. And it is about managing that and also taking a look at some of the digital marketing tools that are out there for us to more effectively touch and reach the broad intermediary community that we're targeting. Much like HCAP, we're generally looking at companies where we can be a first-time institutional investor. Many of those companies are represented by an accountant, a lawyer, a small boutique bank. They don't have the distribution. They don't have the coverage. We got to go find them. They're not finding us, right? So as a result, whether it is marketing campaigns, whether it's social media, whether it's content-driven marketing and segmentation of our own database as we define opportunities. And then the last element is really around some of these thesis-driven searches. At this stage, we're looking and working with executives to help identify some of those opportunities. Either they're coming to us with a thesis or we're approaching them about something that we're considering, and then defining a target set of opportunities that we can go after in that fashion.
Awesome. Thank you, Gerson. So we got the perspective of two asset allocators. We got the perspective of two fund managers. Now let me bring our fifth speaker today. It's Anthony. And Anthony, at your law firm of Barnes and Thornburg, you work in partnership on many of the transactions that, for example, Bhairvee and Gerson would do. I want to get perspective on the pace of the deals and valuations, because in your role, you see the volume rate at any given time. I mean, where are we today?
Yeah, it's a great question. Well, one quick point before I get to that is on the ESG side and impact investing side, the documentation there has become front and center over the last 2 years, I would say. We do work with HCAP, for example, so I can, kind of resonate a lot with what Bhairvee said in terms of having that be a really important piece of the deal. And from a documentation standpoint, obviously, that's where we're coming and helping build in those metrics. It's front and center in the LOI stage, the term sheet stage, putting together an ESG matrix that shows kind of what the measurements are that are important to this investor. And so I think that actually ties in a lot to your question in that the last, couple of years have obviously been very volatile with a lot of uncertainty, but this is an area where I think a lot of folks have coalesced around what's important, right, on the ESG front. So it's good to have kind of consensus around what's important, how to measure those things, and how to actually bring that into a deal. And so to tie into the valuation point, I think, obviously we've seen even this year alone, term sheets go out from certain growth equity investors or private equity investors, ramping down valuation, maybe in an amended term sheet or amended LOI. Still want the deal, the company's still willing to do a deal, but understanding that the world's changed. And I think that's happened, not necessarily overnight, but in pretty quick succession. Obviously 2021, as Sheryl mentioned, was a a banner year. I think we're moving more towards pre-pandemic type deal volume and deal pace. Deal pace, I would say in 2021, late 2020, was a little bit accelerated by the fact that there was kind of a pent-up demand after a very slow beginning of 2020. And also we're moving back to kind of more normal diligence patterns when it comes to in-person management meetings, in-person diligence. A lot of those things were, I would say, not put to the side, but not necessarily emphasized the same way they were, when we could meet each other in person. So we're getting back to those in-person meetings. I think that's not slowing things down necessarily, but actually, kind of creating more deals where there's a focus on fundamentals, a focus on quality, and a focus on the relationship with the manager and the target.
Awesome. So what about the exit strategies, especially in the middle market and low market? That I understand that it's going to be the segment of the market that we're going to be focusing for the rest of our session. What are the exit strategies that are more common in that segment of the market?
Yeah, I think similar to what Gerson said, a lot of our PE clients are engaged in buy and build strategies. So it'll be an initial acquisition where there's a platform company, maybe 5 to 10 to 15 bolt-on acquisitions over the course of 2 or 3 years. And typically in that situation, the exit isn't an IPO or even a SPAC. It's usually an M&A transaction. I think this has become more true this year, given the kind of pause in the market, the SPAC market and the IPO market. It's M&A, and it's M&A mostly to either other private equity funds, larger private equity funds, or PE-backed strategics. So, we've done a couple of deals where we've engaged in a buy and build strategy. Our fund client has maybe $500 million AUM. They're selling to a fund with maybe 2.5 billion AUM or 3 billion AUM. So they're getting a pretty quick return on the cash they've invested over a short period of time with an exit. And in some cases, the management's rolling. They rolled in the initial deal where we helped them, come to private equity ownership, and they're rolling again in the subsequent private equity deal. So they're getting a couple bites at the apple. I mean, in some cases, maybe 3 bites at the apple, given the eventual sale from that PE fund. So there is certainly, I would say, stratification, but it's really good for the lower middle market PE managers, because there is, a whole range of buyers that are a little bit larger, very hungry for deals, that if you've done the hard work of building the platform and assembling these companies with a good management team, they're very attractive targets for those PE buyers.
So I would assume that many of those companies, they become roll-up targets of larger platforms, in many cases. Is the secondary LBO transaction something common on the lower middle market, or it is something that's more on the mid-size market? Yeah,
we haven't seen it too much on the lower middle market. I don't think that means they can't do it. I just think most of the time the LPs in those funds are probably a little bit more eager to either cash out or have some sort of realization a little bit earlier. Some of the larger funds have LPs that can maybe sustain a continuation fund or want to be involved in a continuation fund. So I don't think it's not possible. I just don't think we've gotten to that point yet in the market, but it's certainly something that, to keep an eye on.
Okay, Sheryl, maybe this is a question to you related to that. When you anchor those funds, you are the first check. You're in some way as well defining their strategies. You are maybe putting some of restrictions of what they can do, what they cannot do. What are the common things that you pay attention when you anchor a fund in the middle and lower market? Sheryl, you're on mute. Yeah.
There we go. It's a pleasure to talk about. I think there's 5 key criteria, and we've been talking a lot about different expertise of the various team panelists, and so I think if you look at teams, you really want to see an expertise. Just the same way you'd pick a heart surgeon to operate on your valued family member, you want to see that person has done that same transaction for 10 years, because now they're going to step into a leadership role with a lot of responsibility, and hopefully they can still operate that strategy, time and again. And so A track record doesn't always have to be printed neatly in the book with a fund one manager. Many people know that you can't leave easily an old shop and take the table of returns with you. And so there's some work to be done there, but you want to be able to underwrite expertise built over a number of decades at prior shops. And that really is industry trained. So it's the team expertise, but I think there's also value in understanding the team has been together. So that's where it sort of starts, I think, with track record and team. I think you want to really understand that the strategy is very attractive. I think the more interesting strategies have organic growth and natural ways, don't require a lot of leverage, especially in the lower middle market, which is not always available, and really have just a reason why they will win the deals that they'd like to win. So if you're a team that likes to buy family-owned businesses, you should be have some of the greatest bedside manner, because if you're buying someone's baby, you've got to be have some incredible EQ with people. If you're doing corporate carve-outs, there's a very different type of personality where you're looking for. So there's a range of skills there, but the strategy that your team has the skills to execute that strategy is really important. I think the thing that is actually not as codified in the industry, which we put on our list, is a loyalty factor. And so we want to see that you have to, if you're going to build a firm, you want to build loyal partnerships with LPs for the next 10 years. That's what we're betting. That's what we're counting on. And so you want to see that loyalty in the history of your career. Loyal team members who will join you, people who have worked with you across the table from you, and then of course limited partners who may know of you and be thinking about you, even if they can't be in your first close. So I would say team, track record, strategy attractiveness, loyalty, and then the last one is of course scalability. We are actually an incubator of firms so that our larger pension limited partners can of course appreciate early, participating in their growth at the early stage and get in earlier than they maybe could directly and do the hard work there. But ultimately we're reserving capacity for our limited partners in fund 2, 3, 4, so that they can step into where we started the process and did the early work. So we're really looking for teams who can, get into the institutional landscape nicely and really be value-added players. So that's a long-winded story, but those are the key.
That's great. Sure. What it is the time for fundraising, as a first-time fund manager in this middle lower market? Yeah.
So the thing I think a lot of LPs don't realize how impactful it can be to leave your secure job and tell your spouse, by the way, no healthcare, no salary, and by the way, we're going to be writing checks to support the firm and the infrastructure and set up a new office space. And so that starts running at a couple $1 million a year in a minute before the salary. So the time frame is two parts. The first part is you leave your job, you get the team together, and you have to do all of the setup of the firm, the vendors, the 30 vendors you need to hire, and the office space, and even the LLC agreement for your co-ownership of this firm. So you have to set that up, and that takes about 1.5 years. And during that time, you're getting your marketing message right. And then I think it takes about another 1.5 years to really get in front of the investors and get the closing done. So I actually think of it as a 2 to 4 year process. Mm-hmm. It can go a little faster for limited partners or for general partners who have really, really close LP relationships. Now, it's interesting because the LPs can maybe do the work a little faster or get comfortable more easily if they've been in your prior deals. The interesting thing is my experience is, and this is where the gap is in the market, is that the best deal makers are not on talking to LPs regularly. And so that's a bit of an oxymoron in terms of, so they've got to create those relationships and when they get out to fundraise. And so it takes a lot longer than you think, and everyone's decision process, and then everyone's stack of limited partners is finite. And as I think Rod and others have, Rod especially mentioned, the denominator effect just occurred, where PE hasn't marked itself down, it hasn't been marked down yet. So but the public equity marked itself down. So anyone who had a 12, 14, 16% allocation to private equity desired has now gone up to 15 or 16, 2% higher than they want. But so they're having a hard time allocating. So the market cycle can certainly affect the ability to underwrite new partnerships. But I think at the same time, this kind of volatility in valuations will prove out the skill versus the beta. And so I think we'll have some new parking spots open for new relationships very soon. So, TBD on, fundraising, the xylophone of time it takes, but it certainly has taken longer during COVID because you just couldn't meet in person to get all the work done.
Thank you, Sheryl. I would love to get the reaction from Gerson as co-founder of Ceiba, and maybe as well Anthony. You help firms set up their funds and their firms. So you want to go first, Gerson?
Sure, and I think everyone probably saw my nervous laughter when Sheryl commented on the conversation with your wife and the timeline. I think she had my home bugged because that was exactly the conversation when I left my prior firm and took the entrepreneurial leap. The one comment I will make on that is, in some ways, though, COVID has also facilitated new firm formation because of the ability to interact in this type of forum with potential targets, intermediaries, and investors. You don't have to invest in hopping on a plane, and you can have a smaller footprint instead of the spacious office on top of a New York City high-rise to project that you're real. So, and back to the conversation from earlier, technology. Right? The cost of entry, especially if you've got a background in technology like we do, we were able to sort of get that infrastructure done in many ways ourselves and through some limited outsourced relationships, as opposed to immediately going out and getting a full telco closet set up and a full IT staff, which was what was required 15 years ago if you were heading down this path. So those are kind of my comments to some of the topics that Sheryl hit on there.
Yeah, and I'll just add briefly. I think there's a constellation of service providers that's, I think, evolved over the last few years. It's been really helpful to early fund managers. I think there's some great fund administrators out there that really help in terms of providing the back office. We work with some lower middle market funds that are super lean in terms of their internal staff, but they have lots of resources they use both for the research and for the execution and the account management, all that stuff. So I think that's been a huge help in terms of getting funds off the ground. And the other side of that, I think, is something that Sheryl mentioned, is having a really good relationship with LPs. There are also other financing partners out there that I think it's probably equally important to have relationships with. We have a couple of fund managers we work with that have worked with, plug for private credit, mezzanine debt funds on every single deal they've done. And those mezzanine debt lenders will put some money in the LP pot, for, kind of one-off investments. They've been super loyal to these fund managers, really like the relationship they have working with them. They'll occupy board seats or board observer seats, but having those relationships where you can kind of have a reliable financing source when you're doing a deal that requires acquisition financing or some sort of debt is really important too, because you can come up with the equity. That's a lot of work on its own, but then kind of having to do the work of building up a whole new stack on the debt side might be difficult. So having those relationships, I think, is as important as having the LP relationship. So those are just the two things that I'd add. But I think it's a really important question and a great one.
Bhairvee, do you want to comment maybe on this relationship between buyout managers and debt managers?
Yeah, no, absolutely. I think one of the things that we've sort of just seen in the market over, the last year or so has been, a lot more majority recap deals coming out, right? And I think it's sort of, founder owners wanting to take advantage of, all-time high valuations and, kind of just nervousness around maybe proposed changes to tax structures. And so we've seen a lot of, majority recaps come out as opposed to sort of folks looking for growth capital. And so I think, what we've started to do is really kind of see, is there a way that we can, partner with other folks around the table, whether they be, independent sponsors, funded sponsors, or even other SBIC funds, and try and kind of get, almost a club deal done so that we can, participate in these transactions. So to be able to come in from both the debt side, and then also, get a piece of the equity as well.
Thank you, Sheryl. Bhairvee, thank you. So we are approaching the end of the session. We have, I think, 8 minutes. And I wanted to conclude with aligning this panel to the Hispanic Heritage Foundation mission, that it's building a diverse network of investors and asset managers. And I don't know if one or two of you can conclude your thoughts on diversity. And maybe Rod, especially in your case where you are deploying capital, you have the emerging managers program that might be the right path for emerging middle and lower market players to get access to capital. On the other side, that represents extra work for you because it represents extra work deploying smaller checks than bigger checks, maybe? I don't know. What are your thoughts on that? And how can we make that the deployments of capital go to diverse emerging managers?
Yeah, it's a great topic. As I explained in an earlier panel, we're all about focusing on performance and returns at Lacers. But in order to get the kind of returns that we need to know who all the players are. And for decades, it's been the obvious players out there, some of the larger firms who have that brand recognition that have received a lot of the capital. But we know that there is a large number of smaller managers out there who are doing just as well. Who are outperforming the bigger managers. They're more nimble. They have their own relationships. They're just able to move quickly in the market. And this is really sort of that skill that you need in today's market, is to move quickly and to be smart. And we know that doing business, going out and finding emerging managers, and then ultimately trying to do business with them is going to help boost our returns. It's going to help better our diversification, but most importantly, it's all about the performance. And so in order to get to know these managers, we have to put a lot of work into it. My staff and I attend a large number of emerging manager conferences. I've got an open door policy. I encourage emerging managers to call on me and have an introductory meeting. And then I will introduce them to our consultant and start building that relationship with them. Because as I always say, you never know who the next Vista is going to be, right? Mm-hmm. And so we want to get to know these managers now. And it does take resources and it takes the time, but that's small in comparison to the kinds of returns that we can garner here at Lacers. And because we have a multi-billion-dollar portfolio, small incremental performance increases can make a big difference for us. It can pay 10 more retirement checks or 100 more retirement checks. And that's how we think about it. We certainly want to be a sustainable plan. So knowing who all the players out there and not leaving any stones unturned is a high priority for us. So we're willing to put those resources and the time in to get to know these emerging managers.
Yeah, I'm curious to get your reaction of an article that I read, I think it was last week, when the CIO of Amundi, Europe's biggest asset manager, recently said that he was concerned about, and I think that he was talking more about the large cap industry, where he said, look, in some parts of the private equity market, maybe like a Ponzi scheme, where there was a lot of secondary LBOs, and that's something that, is that something that might be a concern for the large caps, and that's why maybe a certain type of more healthy type of transaction going on at the middle market and lower? Is that something that the concern of Vincent Mortier would resonate to you, or you disagree with that concern that was expressed?
Yeah, that really hasn't been a concern of ours at Lacers. When I came back from the state of Hawaii to be the CIO for Lacers, what I wanted to do was to find out why endowments and foundations were getting better returns than public pension plans. And it's because they are investing in the smaller funds. And I thought that we could replicate that at Lacers. And yeah, our emerging manager program dovetails very nicely with that belief or philosophy. So I would say that it's not really so much of the concern that you just raised, but in sort of in trying to get better returns for the plan, being in smaller funds, being with emerging managers who naturally have smaller funds is really a sweet spot to be in, I think, nowadays. And so that's why we're in that space. And that's why we've gravitated away from the larger buyout space and gravitated more towards the smaller and middle market buyout world.
Perfect. Thank you very much. Very insightful. I think that we are close to the hour, if I'm not mistaken. Do we have any questions from the audience? No, I don't think any. So I think that we can conclude with that. Thank you to the audience for listening to this session. Thank you for the speakers for what you have shared, and especially thanks to the Hispanic Heritage Foundation, Investors Forum organizers and sponsors for giving us this platform, and have a good day.